Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching IndianOpen. Let's go straight to the headlines. Crude prices touch one-month highs after the US stockpiles decline and OPEC members start cutting production despite Donald Trump's threats. India's GDP growth may see a drop in the third quarter as NBFC lending and consumer demand sees moderation. A Bloomberg poll pegs the number at 6.8%. Jet Airways lessors ground another 7 aircraft after the debt-trapped airline fails to honor payments. At least 10 aircrafts have been grounded so far. India demands the immediate release of our pilot captured by Pakistan. Also shares a dossier proving JEM's hand in the Pulwama attack. Well, let's take a look at the trade setup for the day. I just first, before I get started with the global piece of news, just want to mark the intraday of the SGX Nifty because that's shown a spike. It was looking like it'll start off very, very flat, but in line with the slight recovery in the Asian market, the SGX Nifty is now in the green. So just keep that at the back of your mind all through morning. Been important monitorable to see what happens to the Indian markets, and the SGX Nifty will be a key indicator. It is in the green right now. At some point of time, of course, we'll show you how it started off and what it is currently at 2, but there's some uptick there. First, on trade setup, the geopolitical updates. The UK has joined the chorus of world nations urging India and Pakistan to show restraint. China has shown willingness to mediate in the India-Pakistan issue as well. As the headline stated, India has shared a dossier with the Pakistani authorities about JEM's hand in the Pulwama attack as well. So the situation remains fluid. We on our part will give you news as and when we learn them to be confirmed. Until then, we'll avoid really talking about news flow that is surrounding all of us because there is a lot of news flow, I must say. Moving on, the US markets, they showed a very mild move in trade yesterday. At least the headline numbers ended very, very flat. Nasdaq marginally in the green, Dow about 72 odd points lower, the S&P 500 about, well, maybe 0.1% or half, not even 0.1% lower. There was virtually no data flow that came in. Yes, Robert Lighthizer said that until the talks are on, Donald Trump will not levy the tariffs, but it's still a very, very fluid situation. So no cues coming in, and as a result of that, the US markets ending very, very flat for themselves. So what happened though in the world markets was on crude. After the plunge in the prices day before yesterday, the plunge in the US stockpiles led to crude oil moving up about a couple of percentage points. Settled at about 66, I reckon, is where Brent is trading right now. So just keep that at the back of your mind that crude has moved up, and the oil marketing companies and some of the others might show a bit of a reaction on that front in today's session. Speaking of our markets, the Nifty continues to stay below the 200-day moving average. The key point, however, is that, as I said, the SGX Nifty just started off a little bit in the green. The mid-cap index has shown some remarkable resilience amidst volatility. In yesterday's session too, the Nifty mid-cap 50 ended in the green. Day before yesterday, it was a very, very flat day. So very choppy days for the mother markets, which is the Nifty and the Sensex, but the mid-caps are showing some resilience amidst this heightened volatility. And speaking of heightened volatility, just look at that chart and it will show you how high the volatility has been. That to the extreme left of your screen are the last 2 days, the India VIX bars, and they show an uptick which is not quite seen since October 2018. And we all know what happened in October during the period of IL&FS and the resultant volatility in Indian markets. So this is a remarkable spike in volatility. It led to option prices moving up as well. Let's see if today there's a bit of a cool off on the final day of the trading session, of the expiry, I mean to say. Flows continued to be okay. FIs pumped in some money in trade yesterday as well, 423 odd crores. The last few days have not been too bad on the flows front, and maybe which is why the markets have just shown that bit of resilience. Having said that, we might start off marginally higher today. If you had asked this to me 15 minutes earlier, I would have said that we are likely to start off in the red, but the SGX Nifty shown a bit of a comeback, 10,835 as we said at the start of the show. Asian screen is not looking all that bad. This is the SGX Nifty, and as we were saying, there's a bit of a pullback that has come into that index. Maybe, just maybe, we start off marginally in the green. Very quickly, just keep in mind that we will watch out for the India Q3 GDP data to be released later today. The Bloomberg poll is estimating about 6.8%, and the US GDP estimates, preliminary estimates for Q4 will be released today. Remember, there was a bit of a delay in that because of the US government shutdown. So that is the other thing that I think world market watchers will be watching out for. Stocks that you'll monitor in the session today, very quickly. Wipro, they sell Workday and Cornerstone on demand to Alight for about $110 million. Watch out for that stock. Watch out for Odisha Cement. It's very interesting to see that mutual fund units belonging to the company were apparently illegally transferred. This is what the company stated that this has happened, so we take it at face value. SEBI has initiated investigation. Fund managers that I spoke to expressed dismay and shock at this move having happened at a custodian level of sorts. But let's see, we'll get the management to maybe know more about this. Jet Airways continues to remain under pressure. More aircrafts have been grounded due to non-payment to lessors. Let's see if that has an impact on the stock. Credit Suisse has come out with a note on NBFCs. They believe that real estate NPAs may rise in Q4 due to lack of funding, and they remain cautious on Indiabulls Housing, Edelweiss, as well as L&T Finance Holdings. And lastly, CLS has maintained a sell on Vodafone with a target price of 27 rupees. Let's see if this stock remains under pressure. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we should bring to you. We speak in detail about the India-Pakistan issue and the border tension with a couple of expert voices as well. Sanjay Pagalia will be joining us in moments from now. And then to get a market perspective, Hiren. Then we move on and talk about the spillover risk for some brokerages, if it does exist in the first place. Sajid Mankan joins in. He's spoken to a variety of people on this. It'll be important to get a perspective from him. Nikki then joins in to speak about the cement dealers survey and how is it looking like. And then, of course, we follow it up with a quick comment from a cement player, which is Jayesh Doshi of Dalmia. He, of course, joins in to speak about this complaint that they've filed with the regulators. So that's coming up on First Word as well. However, the more important thing would be what happens on the India-Pakistan front and what impact does it have on the markets, if any. I think it's a fluid situation, as we said, and we'll keep on monitoring that with close details. As and when official confirmations come out, we will bring it out to our viewers and to our readers, more importantly, on the website as well. So keep that at the back of your mind. Just one way to assess this is try and figure out what the market reaction has been to this issue. You would largely believe that markets in such scenarios would come off. Now, if you look at the option prices the last 2 days, they have really shot up. If you look at the put options, the March put options, even 10,000 put options, they have spiked nearly 40%. But you could attribute that also to the jump in India VIX. Typically, that has a role to play in the pricing of options too. But having said that, let's see if there is a bit of a cool off that happens as a result of it being expiry date today, and then what happens post that. Let's get started with First Word though. The market regulator has declared the commodity arms of IIFL, Motilal Oswal and Anand Rathi not fit and proper to offer commodity services. SEBI cited the alleged role in the NSCL scam for that order. But does that mean that the other businesses would also face similar action? Well, Sajid Mangan, we're not saying that we are not preempting this, but Sajid Mangan has spoken to some legal and corporate governance experts to get a sense of the spillover risk, if any. Sajid, good morning.
Good morning. Let's put the entire thing in context. This is regarding the NSCL scam, which happened where nearly 300 brokers are involved, and SEBI is undertaking investigation against 300 brokers. As part of the investigations, the first orders have started coming in, and 4 brokerages have already been impacted, which includes Motilal Oswal Commodities, India Infoline Commodities, Anand Rathi Commodities, and Philip Commodities. This is the MF Global, erstwhile MF Global. These orders basically say that these entities or brokerages, commodity brokerages of these entities are not fit and proper. Now, the argument which is being debated now is that how is it that a commodities arm is not fit and proper, but the equities arm is fit and proper? Now, typically, these all entities of a brokerage or a broking house or a company are structured in legally in different entities, right? That's primarily because SEBI has different regulations for every segment of the market, and the licenses are separate legal entities. So it could be argued that these entities are independent of each other, and at the same time it can also be argued that because they have the same parentage, the effect of fit and proper should impact all of them as well.
Arguments on both sides,
on both sides which are there. Now we've been speaking to a couple of legal experts because SEBI's order has been very silent. It just says commodity broking arm is not fit and proper to run, and the reasons, it has given a detailed reasons of why it feels so, because it undertook paid contracts which was against the norm. There are PMLA violations which are there. Now remember, in the past SEBI has undergone put broking entities who have done money laundering as not fit and proper. So the entire group can be hit because of that, because PMLA is a serious violation, whether it is for one or for all, because ultimately the compliance happens at the back end, and it's a common compliance team which does it for most brokerages because of synergies. And in the last 5 years we have seen the structure of the market also changing. FMC getting merged with SEBI, you have universal exchanges coming into being, and you have consolidation of stock broking and commodity brokings together to bring in more synergies which have happened. So the structure has changed, and so why the question is why a commodity brokerage not fit and proper may not impact here. So the argument which has been made by many lawyers is that, one, SEBI has not gone through the corporate veil of these companies to determine who is the actual controlling shareholder or the management for all the entities are. It has given an order which has limited itself to only the commodity broking arm. The second one which they are saying is that it's not all safe for many of them, because many of them have to go back to SEBI with a renewal. When the renewal happens, they have to show compliance that their arm has complied to the SEBI regulation. At the same time, they also have to give a compliance that their associates have also complied, and disclosures have to be made as complied to the SEBI regulations. It is there then that the issue may come in, where SEBI can challenge them, saying that your associate is not fit and proper, so why should you be given a renewal of a license? Now these are something which is an ongoing debate. Lawyers have been saying that, no one has defined fit and proper properly. Even the courts haven't defined in terms of law. So it is an interpretation of the regulator which is now being said. Now brokerages have said so far that they have wound down the entire operations of commodities for last few years, so they are not impacted. They are weighing legal options which include appealing in SAT, and as of now other segments are not impacted. So it is a debate wide open. SEBI has started the guessing game, and now people are guessing what will be the next thing. There is no clear indication which has come from SEBI. One reason which I feel is that these brokerages are big in terms of market volumes and share. A sudden not fit and proper against many of the top brokerages may impact the system. So SEBI wants to take it in a gradual way going forward, instead of putting it one order one day and say that now you shut your shop.
But that's also a presumption, right? We do not know, because the arguments are open on both sides.
It's a mature way of looking forward, because when the renewal comes in, you bring in more stringent things and you do a transition. Now the comparison which have been made for the past is that, Jignesh Shah was NSCL, if NSCL was also independent of others, then why was he removed from all other exchanges? But now that happened at the parent level, it didn't happen at the subsidiary level. So there are many, it can be a parallel which can be brought in here.
Okay, so arguments on both sides. Essentially, Sajid, but while we're speaking of the market regulator, it's also looking to tighten the open offer norms, and one company that might get impacted because of this is Jet Airways.
Yeah, it's a very important move which has been planned at tomorrow's SEBI board meeting. They're trying to tighten the exemptions which are available for open offer. Under that, there's a clause called a competent authority. Now that's a very vague term used to get an exemption from open offer. To give you a backgrounder to it, when SpiceJet went through a turmoil, We had Ajay Singh coming in, buying the airline for 2 rupees. We have reported all that. But there was no open offer made by Ajay Singh to the shareholder, minority holders of SpiceJet. The reason being that DGCA, being a competent authority, had exempted, given them to take over the operation and exempted, and asked SEBI to give them an exemption. That same exemption, SEBI used that argument, saying that that's the reason we did not seek an open offer and we gave them an exemption. Now, the competent authority itself is a very broad term which has been put in, which is there in the law. And now what SEBI is trying to do is that remove that clause. Now, if SEBI removes that clause, it will impact Jet. That reason being that Etihad is not, doesn't want to make an open offer. Open offer regulations require massive disclosures, and Etihad being owned by a sovereign and sovereign fund, they will have to make disclosures with respect to what the sovereign's financials are, everything. And that's one of the main reasons why Etihad, in the earlier avatar, when they came in, didn't want to make an open offer.
Okay.
Now, if there is guidelines there, right? No, open offer needs a pricing, and there's a pricing ICDR guidelines for pricing of preference shares as well. All those exemptions will also go away with it, because Etihad wants to make a offer or infuse funds at 150 rupees, which is widely known, and the current price is around 225, 230 or something of Jet. Now, that is also a big issue, because if Etihad has to make at a higher price, then the deal is almost in a pickle, simple as that. So it's going to be a tough task for lenders, because lenders, if they convert their shares and get a 51% stake, they don't know whether Etihad will be able to come and take a 24% stake and infuse funds into the company.
Okay, so in a nutshell, Sajid, 30 seconds, if you can explain in a nutshell, if the norms get changed, what's the impact?
If the norms get changed, Etihad will have to limit its stake to 24%. That means another 12% it can get in, because beyond 25%, it's not it has to make an open offer. Secondly, the pricing will have to be as per the SEBI guidelines. So even if you assume that Etihad makes the pricing, it may not be able to go beyond 25%. That means the controls are still going to be with the financial lender. So it's going to be a very tough task for financial lenders or anyone to convince SEBI that this is required for that, because this entire structuring is, though under February 12 circular, it's not through the IBC. SEBI is making very clear that we are going to exempt lenders who are coming through the IBC with exemptions.
Okay, so important board meet tomorrow for multiple reasons, including for Jet Airways individually as well. And I'm sure we'll keep you updated with that. Sajid, thanks so much for joining in this early in the morning and giving us all of those perspectives. Well, let's move on to the next piece. 2019's bringing some good news for cement makers, with pricing power returning to at least some of the bigger players. While some of it can be attributed to the cyclical uptick in construction, the sheer volume will put a smile on some of the faces. Nikki Mirchandani has done a survey amongst 14 dealers in the country, which is pretty exhaustive, to find out just how much does a bag of cement now cost. Nikki, good morning.
Good morning, Neeraj. Cement pricing power clearly seems to be crawling back to the industry's second consecutive month of price hike that we've seen. And also it's the steepest, at least in terms of the monthly price hike. It's the single largest hike that we've seen at least in a year from now. If you look at those prices in Jan 2019, 150 kg cement bag costed you around 321, and now it is gone up to that 335 level. So clearly a good 14-15 rupee hike that pan-India players have undertaken. Mainly the price hike is driven by the South Indian players and followed by the Western and the Central region. We spoke to a number of 14 dealers across the 5 regions, and they suggested that it was the pickup in infra activities along with the price hike that was undertaken by the Holcim Group company, that is ACC and Ambuja Cement, which are now behind the their year-end volume pressures, which have mainly led to the uptick. Importantly, the price hike is coming in from the southern players, because these are the players which go ahead and dump their excess to other producing regions, which in turns weigh down on their price hiking ability. Look at the chart out there for South Indian players, where the price hike for Feb 2019 has now shot up to 360 rupee per bag as compared to 310 that we saw in Jan 2019. snapping 6 months of declining trend. The South players have taken that hike of rupees 50 per bag. That's the highest that you'd see from Feb 2018. And also, until now, the price cuts were to the tune of around 30 rupees, and the price hike taken is for 50 rupees. So clearly offsets the kind of loss that we've seen in the entire year. But then the dealers suggest that sustenance of this kind of levels seem to be difficult because Tamil Nadu is still supplying in excess of what the demand is. Next, we have also good news coming in for the other region, which is the western region, where the prices are now around that July 2018 kind of high level at 314 per bag, as compared to what we saw in August, which was around that 315 kind of odd levels. So clearly good amount of uptick that we've seen in western region, which is followed by central region, which anyway had a good pricing power, and this is for the second consecutive month that we have seen these price hikes. The prices, however, have remained stable in eastern and the northern region. The northern region as such has seen a lot of price cut, but then this time around, last 2 months, we're seeing some kind of stability coming in the prices, 306 and 331. Well, in terms for the eastern region as a whole, which is the blue line out here, there you would see the prices remaining flat around that 331 kind of level. But then the dealers suggest that going forward in the month of March, we can expect a 10 rupee bag per hike coming in for eastern region. And that's not that. We're actually looking in for more price hike. We spoke to Sanjay Ladiwala, who is a cement market expert, and he suggested that the prices are expected to go up from here on, and this is just the start, and we can expect the continuation to be until June, July of this particular year.
Okay, Nikki, thanks for putting that into perspective. And you can, of course, read about this a bit later on the website as well. However, as we said, the biggest draw today, the last 3 days, have been the tensions between India and Pakistan, which have escalated after the Indian Air Force pushed back an attempted airstrike by the Pakistani Air Force. In that aerial engagement, one Pakistani fighter aircraft was shot down, but India lost one MiG-21 jet, and an Indian pilot is missing in action. India has demanded swift and safe return of the Indian pilot in Pakistan's custody and strongly objected the injured personnel's display in violation of international humanitarian laws and the Geneva Convention. The Ministry of External Affairs has also handed over a dossier to Pakistan with specific details of Jaish-e-Mohammed's involvement in the Pulwama terror attack and the presence, its leadership in Pakistan rather. India has called for immediate and verifiable action against terrorism by Pakistan. Meanwhile, Pakistan Prime Minister Imran Khan offered to diffuse tensions through talks, even as he cautioned against any miscalculations and escalation of the border tensions. How are markets preparing for these risks from the border tensions? It's important to get a big voice every day. This morning, Saurabh Mukherjee of Marcellus Investment Managers speaks to us. Saurabh, really appreciate you taking this call at such a short notice. We'll make it quick. Thanks so much for joining in firstly. And
Good morning.
And just wondering, Saurabh, what have you made of the market behavior in the last 2 days amidst all of this news flow? Does it tell you something?
I think first and foremost, all of us realize that far more important than the stock market in such circumstances is people's lives, soldiers' lives, pilots' lives. So I think being cognizant of that, it's a relatively small matter as to what stock markets do in such circumstances. Most investors, I think, are taking all of the rhetoric between the two countries with a degree of skepticism. Both countries understand that the stakes are high, and even if this escalates to a Kargil-style 2-3 month conflict in a single theater, an economy as big as India, $3 trillion economy, financially can deal with the cost, and that's why I think you're seeing the stock market being relatively sanguine about the impact of this conflict on the market itself. So they're a $3 trillion economy now. Even a 2 to 3 month Kargil type conflict in one theater, the financial impact on India can be dealt with. Obviously, the human impact, the impact on lives and the impact on our soldiers and our Air Force people is a different matter altogether. But at a financial level, people like us in the stock market are taking the view that this is not a big deal for the stock market, even if it escalates into a 2 month conflict in one theater of war. If it goes beyond that, obviously it'll be a tragedy on many different fronts. But on the small matter of the impact of the stock market, I think most people in the stock market are taking a sanguine view that there isn't that much to worry about at this juncture.
Saurabh, I really appreciate the way you've put this into perspective, and I completely agree with you on everything that you said. However, I just wanted a perspective now on this small matter. For now, there is a bit of resilience. If indeed the tension gets diffused in the next 1, 2, 3, 5 days, if it does, do you reckon that the markets will take it positively, or would it be status quo? That's that small thought that I wanted from you.
I think there we go back to where we were, I think 2-3 weeks ago, which is that depending on how the financial system deals with the issues in the wholesale money market, the issues around housing finance companies, real estate developers, around promoters holding vehicles. So we'll go back to dealing with that as the major issue. We'll go back to looking at the oil price and seeing whether it moves up to $70 or not. As I've said for the last year and a half, I think fair value for the Nifty is around 9,500, and barring consumption, which is in great shape. I think small ticket consumption, whether it's apparel, whether it is FMCG, is booming. Barring that, it's difficult to sort of make a bullish case for capex revival just yet. So once these tensions abate, and let's hope these tensions abate quickly, we'll go back to the issues we were grappling with for the last several months, which is the problems in the money market, the comatose state of the capex cycle, alongside a pretty thriving consumption cycle in our country.
Okay, Saurabh, my final question: in the worst case scenario, that the situation, I'm not making any assumptions about whether it escalates or otherwise, but let's assume the stress remains, the tension remains. Then do you think it weighs in on the market, and does the market correct, or is that a very difficult call to make right now?
Even if tensions remain, provided it doesn't escalate into a major conflict, right? Even if tensions remain, it doesn't escalate into a major conflict. I don't see the stock market being too swayed by this. We have level-headed people working in the Indian investment community, and they understand whilst emotions are running high in India and in New Delhi, just the sheer size of the Indian economy is such that on a financial scale, and I stress again the financial scale here is relatively unimportant given what's at stake here, but most level-headed people in the financial community realize that the financial stakes are not as high as the sort of the stakes in terms of national honor and pride are. So even if the tensions continue, I don't think this will be the main driver of the stock market. The stock market has other issues to focus on, and that's what it will continue to do, even if the sort of simmering tensions between India and Pakistan continue.
Really appreciate you taking this time in this morning and talking to us, Saurabh. Thanks so much.
Thank you.
That's all that we have on First Word today. Quick programming note. We talk about the market reaction and how well the broader markets have behaved amidst all of this volatility with Andrew Holland of Avendus Capital Alternate Strategies, the business outlook for VIP industries with Chairman Dilip Piramal, and speak to Federal Bank Shyam Srinivasan about the asset quality, loan growth and more. But after this break, a full tilt towards the day's trade.
Fulfill your dreams of buying a new house, new car, or achieving academic success. Attractive interest rates and easy processing. The trust, commitment, and excellence since 1937. Indian Overseas Bank, good people to grow with.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. Only on Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
You're watching IndianOpen right here on Bloomberg Live. Good morning, Neeraj. Very volatile session today. Hopefully, yesterday. Hopefully today turns out to be slightly more sanguine than yesterday. It's the expiry day, so you can't cut out the volatility per se because the last half an hour is still going to be more active.
Yeah, but 2 days of such big spikes. Let's see if there's a bit of an ebbing in the volatility. The option prices, Devin, as I'm sure you and Agam will discuss, or we and Agam will discuss, have shot up. But let's see, from 18.9 odd. It's at really levels, close to levels from where it usually tends to subside a bit.
Yeah, and I was just looking at the last few months' data with regards to the volatility. And, the last time that we saw this kind of a spike was, in terms of the actual percentage of the wicks changing, was October 2018. And the very next day, we actually had a good open and a strong green bar, which was a strong positive move. This happened again in December 2018 when the wicks actually touched 20. And the next day was again a big green bar that came in. So I'm not saying that today you'll see a big major move coming in there, but the setup looks positive. SGX is showing you 1/3% move on the upside. So at least the start can be a positive one. But let's see how we set up for the futures and options segment. It's expiry day. The volatility is going to be a factor. Agam, good morning.
Good morning. I think you guys made a couple of very important points. First, when it comes to volatility, because of the fact that we have seen that rise, there is always that possibility of the volatility falling to a certain extent. Secondly, we must remember that while we have seen a lot of news flow, the benchmark indices haven't really moved as much. The Nifty is still well above the mark of 10,800, and this is after the kind of the up move and the down move that we've seen on an intraday basis. At the end of the day, this is what we are looking at. And rollovers is perhaps the only thing that is just a tad below the previous 3-month average, and that is also once again because a lot of traders out there will be hesitant to roll over their positions into the next series. So if you leave that aside, a lot of other factors will indicate that there could be some amount of sideways movement. The VIX, of course, rose as much as 10.5%, and I've spoken to traders out there. If we do not see any more news flow with respect to the rising tensions, then this number will largely remain around this mark, or we could see a little bit of temperance in this number. But when it comes to this particular series, what we saw yesterday was a little more, unwinding in the 10,800 put, considering we saw the Nifty come off to a certain extent. And naturally, we will see a little more writing around the 11,000 call mark, considering that is something that traders are betting against Nifty moving. And, that is the same picture when it comes to your open interest distribution here. Your put call ratio, of course, largely unchanged for the Nifty or the Bank Nifty for that matter, considering the indices didn't move as much. 3 stocks which are in the F&O ban at this point in time: Adani Enterprises, Power, and Reliance Power. 2 stocks which move out: IDBI Bank. But Jet Airways in trouble with 7 more planes grounded. Well, it's moving out of the ban, which is why we are likely to see a little more sharp movement in this one. In terms of other stocks I'm keeping an eye on, at least in terms of today's expiry, we really didn't have too much movement with respect to stocks which saw an increase in open interest. But when it comes to unwinding, and there'll be a whole host of counters out there, but this is largely because we are moving into expiries. Among a few stocks that stand out is Ajanta Pharma and Sun TV. So mixed cues again, and we're going to continue to track developments and how they impact markets.
All right, Agam, thanks very much for that. But an interesting point on the rollovers, while they are on the lower side, yesterday Kannan spoke to us and he spoke about the rollover cost being higher. From the average is about 48 bips, and he said it's currently about 52 bips, which means that at a market level of 10,800, which is not too far off from the highs that we recently saw, longs are getting rolled over, and you know, people are ready to pay that extra buck to roll over their long positions. We'll wait and watch as to how the last half an hour the rollover shapes up, but not to be too disheartened by this number just yet. Parthiv Shah, director at TRACOM Stockbrokers, he's joining us on the show right now. Parthiv, good morning to you. What are you making of the current situation, particularly from a market standpoint? From the looks of it, it looks like a fairly mature market, not too much in terms of a knee-jerk reaction to the geopolitical issues.
Good morning, Devina. Yes, you very rightly mentioned we are a far mature market, and I think, frankly speaking, there's been a lot of rhetoric talks about a pre-election rally just because of the recent skirmish. I think everyone is anticipating that the incumbent government will form again a government with majority. I think probably that's not how one should treat the markets or go into the markets with an investment philosophy. At the end of the day, it is all about which companies you own and how the earnings in those companies pan out. So we are far more comfortable, I think, sticking to the fact that it's better to cherry pick your right kind of stocks and sectors and how earnings will pan out in those names, vis-a-vis trying to preempt in terms of what will be the impact of election with the recent developments. And yes, I think, God forbid, if things were to escalate, I think we've seen there could be a sentimental impact. And that's where I think the smart investors would have their money ready and I think their homework done in terms of the cherry picking of the selected stocks and sectors. We've seen historically, I think, if I have to go back in history, even during Kargil war, I do remember that in a week's time, the markets had corrected by almost 8%. And the dip that was bought into by the smart money back then, I think was very richly rewarded over the next 1.5 years. So I think we would stick to the similar story. We are not trying to predict what happens in the election with the recent developments. It's better to stick to your philosophy of investments rather than trying to predict things which are not in our control.
Very, very sound advice. And maybe part two of that advice is keep emotions out of the investing bit right now. Parthiv, so much to speak on specific stocks too, but before we get started there, maybe it's a good idea to get in our research team to talk about what are these stocks. Some stocks in news, some brokerage calls as well that have come in, and very interesting couple of notes that have come in from the brokerage community today. So Mishika and Yash join in to talk about that. Both of you, good morning. Mishika, let's start off with the stocks in news first.
Yeah, so these are the stocks that we need to keep an eye on today, starting with Wipro, aligned to acquire Workday and Cornerstone on demand business. Deal for cash consideration of $110 million. Wipro expects to close the deal during Q4 of FY19. Business was acquired by Wipro in 2016 as part of the Aperio buyout. Then we have Odisha Cement. Certain mutual fund units worth around 344 crores have been illegally transferred by the depository participant. Units were held by erstwhile arms OCL India and Dalmia Cement East. The matter has been reported to appropriate authorities and investigation has been initiated by SEBI. Then we have Fortis Healthcare. IHH says that occupancy at Fortis has increased to 65% currently from 62%. IHH is currently performing a purchase price allocation for the acquisition. Tata Metallics to increase DI pipe capacity by 2 lakh tons per annum and hot metal capacity by 0.7 lakh tons per annum. The capacity will be expanded by FY22 with an investment of 555 crores. Board also approved issuance of 29 lakh equity shares and 36 lakh convertible warrants to promoter Tata Steel on preferential basis. If shares and warrants are issued at yesterday's closing price, then company would raise close to 380 crores. According to Bloomberg Quint calculations. Upon conversion of warrants, promoter holding in the company would increase to 60.3% from 50.1%. And lastly, you should look at Jet Airways. 7 more aircrafts have been grounded due to non-payment to lessors. So the total number of grounded aircrafts is now 9, and the fleet has been reduced to 115 aircrafts. The company says it's making all efforts to minimize disruption to its network.
Okay, we'll watch out. Let's see if there is minimal disruption to its share price today or no. What about the brokerage notes though, Yash?
Right, Neeraj. So I'll start with CLSA, and they have a note on Vodafone Idea, and they maintain their sell rating on the stock and have a target price of about 27 rupees. Now, they say that going regional can help the company cut down its debt by as much as 25% and boost its EBITDA by nearly 20% in FY20. And a strategic move from a pan-India player to a regional and a focused operator would aid the company's revenue growth going forward, which is expected to grow by about 10% higher, as a result of which there could be a jump of about 2.5% in its fair value. Moving on, we also have Nomura on Infosys, and they have a neutral rating on the stock and a target price of 618. This is on account of the weak outlook that the company has, guiding for the possibility of weaker margins in the fourth quarter versus the third quarter. This is given the back-ended nature of its investments, large deal transition costs, and likely one-off resets to counter the high attrition. This possibly raises the risk of a cut in its FY20 EBIT margin guidance to 21 to 23%. So these are the two stocks you need to watch out for.
Okay, we'll watch out for all of these. Thanks a lot for that, Yash, as well as Mishika. Parthiv, I'll come to you firstly on Jet Airways. Do these issues weigh in on the stock price, you think, or is the price discounting the issues, and at some point of time the corporate developments would be center stage?
I think the key for the current shareholders of Jet Airways would be any sort of major corporate development wherein I think the existing promoters are out of the game and somebody new takes over, and that somebody new has to be a player who has vast experience in turning around airlines business, also having vast war chest in terms of trying to infuse funds. But we have seen historically, Neeraj, that whenever such companies are bailed out, or for that matter even ATR talking about infusing funds, see the levels at which they are talking about. They're talking about levels of 135 rupees in terms of the rights issue money that they're trying to infuse. So I think I don't see much of a trigger at this juncture. One will have to wait on the sideline. I think still, if one wants to play the aviation sector, we always talked about and advocated Interglobe Aviation, and even they will have some hard time with crude inching up. But I think Jet Airways for the time being is a clear-cut avoid from our end, unless and until the corporate developments over the longer horizon give us any sort of visibility that there's a turnaround scope. We don't want to play that 5-10% sort of a move in Jet Airways because one can get on the wrong end. But I think totally Jet Airways from our point of view is totally an avoid at this juncture.
All right. Coming back to our guests then, and joining us right now, we've got our technical experts. Sameet Chouhan, Chief Analyst for Technical and Derivatives at Angel Broking. Along with him, Shrikant Chouhan, Senior Vice President for Technical Research. Kotak Securities is joining us on the show. Gentlemen, good morning to both of you. Sameet, I'll start off with you first on the index. Today is the key expiry day for the February series. Going to be expecting volatility. What do you do? Do you take a trade for expiry?
See, such period are very difficult. It's a challenging period for any momentum trader. If you see volatility has increased substantially, India VIX has increased, and with the last 3 days movement, we can see a defined range now. On the higher side, 10,900, 930 is the level to watch out for, and lower side, Tuesday's low of 10,730 would now be seen as a key support zone. So unless Nifty breaks out in other direction from this 200-point range, we are unlikely to have any kind of trended move. So we expect this consolidation to continue, wherein a lot of individual stocks, if you see in last 3 days, although we are seeing volatility in the market, but there are individual pockets that have been buzzing and that have been outperforming. So one should keep focusing on such stocks. As far as today's expiry is concerned, now 10,800 would be a crucial support for first half. If we manages to hold this important support level, then probably we might see this expiry happening beyond 10,850. So as of now, we are not taking any call, but in case if Nifty again dips down to a 10,800, one can play with a plain vanilla call, 10,800 call option, and then accordingly one can place their bets. But as of now, one should keep focusing on individual stocks.
Okay, and we'll come to those stocks in a bit, but let me just quickly get in Shrikant's index view first. Shrikant?
Good morning, everybody. See, for Nifty, one thing is very clear that the downward pressure is increasing. It is failing to hold higher, and whenever we see a market is under uncertain news flow, and if VIX is trading around 19, very close to expiry, that time we see downward pressure in the market, and based on that we have designed our trading strategy to trade short if there is any higher opening close to 10,850, 860 area, and in that we can keep stop loss at 10,900, and again on the downside we can expect 10,750 or 730. Till the market is about 730 we can expect range bound activity, but certainly if there is any higher opening, then certainly we should look for taking some contra bet of going short in the market. For Bank Nifty also, there is like a huge amount of resistance around 27,100, 27,150 area, and on the downside 26,600, 26,650 is more likely. So there also our strategy should be to creating short positions at higher levels.
All right. Coming to those stocks then, post the index opinion. Let's start off with you, Sameet. You said it's time to be stock specific rather than trade the index. So which are the stocks that you're betting on?
So we have three ideas. Three would be on the long side. Sun TV, in last 3 weeks, the stock has done well. We have been up bet at low levels, and it appears that the stock has formed a strong base and it's now gearing up for a strong relief move. Day before yesterday, we saw a decisive breakout from this important resistance zone. Yesterday, some kind of profit booking. But according to us, previous breakout points are likely to act as a very strong support, and from here on, the stock is likely to resume its uptrend. And hence, one can go long in Sun TV. It's a positional buy with a target of 655, stop loss 570. Second buy would be on McDowell. If you see, despite we are having a strong profit booking at higher level in the latter half in the market yesterday, McDowell has managed to buck the trend, and it has given a strong close above its important resistance zone. So looking at yesterday's move, we expect continuation of this rally. Immediate target would be around 568. One can go long around 521. Apart from this, clearly the entire PSU banking basket was buzzing yesterday, despite the broader market having some kind of profit booking. Allahabad Bank is the one stock that has been consolidating, and it's now showing early signs of revival. So we expect Allahabad Bank to move higher. Target 51, stop loss would be 44.9.
Shrikant, what about your picks?
We are more focusing on pharma companies. There we are expecting good amount of price attraction as well as volume expansion. Yesterday, Aurobindo Pharma was somewhere around 720, 722 levels while closing, but the way the stock is in a range, and again it has reversed very sharply from its lower levels of 700. We are of the view that the stock is heading for at least 750, 760 sort of levels, but in today's date we can expect 740, 45 on the high side. So here we have to keep stop loss around 714, 710, and we should look for adding Aurobindo Pharma to our trading portfolio. We also like Sun Pharma as well as Dr. Reddy, and overall basket is showing a lot of momentum. So our focus should be more on pharma companies. Apart from pharma sector, we also like metal sectors, but right now we are feeling that they are very close to their important resistance area. Tata Steel, JSW Steel, Vedanta, they all have achieved their important resistance mark, and from here we can expect some downward activity. Vedanta has already given reversal signal, and one more decline to 160 or 157 levels is not ruled out. So at current levels, we should look for creating short positions on Vedanta with the final stop loss at 167, 168, and on the downside we can expect minimum 160, 157.
Okay. Stay on with us, gentlemen. On to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock today on your list?
Morning, Devina. So we are tracking Colgate Palmolive on the charts, and there's a buy signal coming on the back of the MACD indicator. Before we start, let's try and understand what it is and how do you interpret it. The MACD is basically a trend following momentum oscillator, and it helps you identify the relationship between the two moving averages. A bullish signal is generated when the MACD line crosses above the signal line, and a bearish signal is generated when the MACD line crosses below the signal line from the top. In terms of Colgate Palmolive, in the lower panel over here shows the MACD indicator. The blue line has managed to cross, or has given a positive crossover with the white line over here being the signal line, and that indicates a a possible up move in the stock from these current levels. Now, what we saw even in yesterday's day of trade is that despite a significantly heavy volatility on account of the Indo-Pak tensions, the stock managed to close higher by about 1.5%, with volumes too being decently higher than its 20-day average. And on the back of that, even on the longer term charts, the stock is trading above most of its key moving averages, so the trend suggests to be positive. Additionally, not really a technical indicator, but yet again a proprietary Bloomberg function, which is the seasonality chart. And if you could take a look over here, in March has been the best month to accumulate a Colgate-Palmolive. As you could see, all of the last 5 years in the month of March, the stock has managed to give positive returns. And if you take a look at how the next 3-month trend has also been, it has managed to give positive returns. So maybe just a good time to accumulate Colgate-Palmolive according to the technicals as well as the seasonality chart.
Okay, the seasonality chart is but history, but the technical charts probably indicate some upsides. Yash, just wondering how, maybe you mentioned it, but the pure technical levels for today and the indicator, how well has it worked for Colgate-Palmolive in the past?
Actually, that's worked very well, because 7 out of the last 8 times that the indicator has given a positive crossover, it has managed to run up as much as 7% over the next 1 month.
Wow, that's quite something. Okay, let's wait and watch Colgate-Palmolive. We'll ask Parthiv about this as well, but just a quick programming note. While Yash brings about this Bloomberg Edge at about 8:50, we also get you a version of Bloomberg Edge on BloombergQuint.com, where we identify technical triggers that have emerged on a specific stock or a sector every day. This is based on proprietary Bloomberg indicators, of course. On today's Bloomberg Edge, we feature HDFC and what its relative rotation graphs and open interest charts indicate. That is a BQ Blue exclusive, so do tune in for that as well. Parthiv, get back to you. Colgate-Palmolive, a case in point, that or some of the other staples. With this whole move of this Pradhan Mantri Kisan Yojana that was done, it all got lost amidst the geopolitical tensions. But would you believe that plus others would lead people to maybe buy more soap, more shampoo, or branded shampoos, branded soaps, etc., and therefore and branded toothpaste, and maybe that would help some of the staple companies?
Firstly, Neeraj, on a lighter note, I'm not trying to figure out how there could be seasonality in terms of brushing teeth, because it is like a 24/7 and all weather sort of.
It still shows. Think about it, it still shows. The stock price shows.
It does. So certainly, I think there is this 2,000 rupees for the time being, the disposable income, and the rural growth story still, I think, has a huge potential. No doubt this stock does not come cheap, but the return ratios are the best in the industry. And I think if one is buying Colgate-Palmolive out here, one will have to assume that, one will have to wait for a time correction sort over the next 2 years in terms of the returns, but post which I think the returns can be very, very exciting. And I think even the mere talk about, at least brushing twice a day, one at night and one in the morning, can help it increase its volume, which is still not a culture in our country, which is very much there in like the Western world. And they have lots of proxy products like floss and etc. that they can launch. So I think we feel that, this is a management which has countered any sort of threat from Patanjali in terms of the Ayurvedic culture of brushing one's teeth. I think they have already launched those products, and I think they are having fantastic maintenance in terms of the market share. So I think it's an evergreen blue chip. Even at these juncture, these levels after the rise, we find it very comforting to have such a stock in the portfolio. Only one has patience over the next 5-10 years.
Okay. The composition of the Nifty too has started to tilt towards consumption-oriented names now. You've got one more name coming in, which is Britannia, again a consumption-oriented name. I'm not just talking about staples like ITC, HUL, the likes of Britannia now, but consumer discretionaries as well. Autos have a significant holding on the index, and now a major bulk of it comes in from the pure play staple companies as well. So how do you view this composition now on the index, and how much more prominence do you give to consumption-oriented names?
See, I think, Devina, there's no two ways about it that consumption is going to be an evergreen theme in our country. It's all about what price we are currently paying for certain stocks in terms of the valuations. And I think what sort of challenges they could face in the short to medium term. Long term, I think they are scalable businesses. They are businesses which are generating fantastic return ratios. But I think out of all the stocks, yes, I think this is something that we have discussed in the past in terms of the valuation call. I think my bias is still in terms of the valuation call and futuristic scalability of its FMCG business growth would be with ITC. See, I think this as a company, one is always talking about the fact that the FMCG business will be very big. And right now, I think the margins are not at par with most of its peers. But I'm very confident that this is a type of a management that after the certain scale that they'll bring to the FMCG business, I'm not even talking about the cigarette business, which you all know is a fantastic cash cow generator. But even in the FMCG business, I have a lot of confidence that after certain scale, they will start working on the margins and cost rationalization. Right now, it is all about having market share, launching new product categories. And once those categories are set up, I think we are not even talking about that 2030 target of touching a 1 lakh crore sort of a top line. But if HUL can be a 3.5 lakh crore sort of a business, pure FMCG play, I don't see a reason why over the next 5 years, 7 years, even ITC can mimic that business and have such a market cap only on its FMCG business. So I think this can be a nice 16-17% sort of a compounder with very good dividend payout and a great management pedigree. So I think ITC would be my consumption bet over the next 7-10 years.
Cement counters yesterday were extremely active in trade, and it's interesting to see whether or not there's a trading play out here. Sameet, Chouhan, any of the cement counters that were active yesterday, from the larger names like ACC, Ultratech, to the smaller ones like Prism and India Cements, Ramco Cements?
No, in fact, as a disclosure, we were a bit on ACC yesterday, and as a momentum play, we had advised, buying 1400 call option. We have already booked out, but still, if we look at it from a slightly broader view, it appears that stock has, undergone a massive time-wise correction, and yesterday was the first day of revival. So from here on, ACC is clearly heading towards its higher end, which is in the zone of 1470 to 1480. So yesterday's dip was clearly a buying opportunity. One can go long at current level also, and it is offering a good risk to reward ratio. One can keep a stop loss around 1388 and go long for an immediate target of 1470, 1480.
Banks were active too in trade yesterday. Almost all of the banking counters were up and about. Shrikant, anything in the small sized PSU banks that you would initiate a long on? Quick 30-second answer, please.
See, for PSU banks, we like Bank of India, which is trading around 81, 82 levels. And there we feel that the stock has formed bullish divergence on weekly as well as on daily basis. So it's a classic bet to buy. Again, here the risk reward ratio is quite favorable. And I'm of the view that if there is activity or momentum in all PSU banks, then we can expect Bank of India to outperform. So it's a buy at this price. We have to keep stop loss little bit lower on the 77 levels, and we can expect 90, 91 sort of levels in next couple of weeks.
Okay, that's Bank of India there. In the next couple of weeks, about 1991 is what Shrikant envisages. All right, 30 seconds left to go for market pre-open. It looks like we could see a positive start. Extreme volatility last few days. Today's session is important because it's the expiry day of the February series. You may encounter more volatility today as well. That's Asia for you. More mixed bag right now. Sans Hang Seng, which is trading in the green. You've got Shanghai and Nikkei down by 0.25% to 1/3%. That's the SGX Nifty up a quarter, 27 points higher, 10,831. Pre-open on your screen, marginally lower there, about half an hour. All right, just keeps fluctuating. The volatility, the pre-open session is also pretty high. So we're going to wait and watch for the index levels, give it some time to cool off. But let's go on to look at specific counters and specific stocks on the index. So Indian Oil, that is up about 2.5%. HCL Tech moves up to 2.5%. We've got a IndianOpen Bank, more volatile right now, but showing you a 6.5-7% tick. HUL 2%, Bharti Infratel 1.5%, Bharti Airtel another 1.5%. Tech Mahindra, Asian Paints, Dr. Reddy's, Ultratech Cement, your top gainer of yesterday's session, opens with gains today as well. Tata Motors 1.5%. Remember, Tata Motors is an interesting one because post its quarter 3 numbers, after it actually made those those mammoth losses, the stock has actually in the last 7 days gained almost 9%. So, gonna watch out for that one closely. Sun Pharma, TCS, all in the green. Dr. Reddy's, we've got Hindalco, Grasim, Reliance 1.5%. Good gains, in fact, across the board. You've got a majority of the gainers, just a handful of losers. That's 4 stocks that are in the red, including ONGC, Tata Steel, Kotak Mahindra. But all the gains that are there from stocks are more than 1%, closer to 1% or more than 1%. So the quantum of gains that are coming in are on the higher side this morning. For the currency, yesterday's close 71.24, 71.21 is where the rupee has opened up for trade. So no major move on that front. Bond market yields will come up on your screen as well. 7.47, so that is becoming a bit stiff right now, so we're going to be closely watching out. Had made a quick move from that after staying within that level of 7.36, 7.37. The last few days have been pretty steep and swift in terms of the move on the yields.
Yes, yes indeed, 7.47 will be the highest levels in the last few days for sure. What's happening at the broader end of the spectrum? Jet Airways for now is showing a 10% downtick. I don't know if it will be a 10 or a 5 or a 2, but maybe there is some downside here. Rain Industries continues from where it left off yesterday, so was down about 10% in trade, now down about 4%. Poor set of numbers. Margins collapsed, literally collapsed from 21% to 4%. And that just shows you the pain that the company had in the quarter gone by, and that stock is correcting. Motilal Oswal has some losses to itself, but aside of Kesoram has some losses. Now, I don't know what the cement players are doing. The likes of Ramco, which had a big up day in trade after that brokerage note and this whole conversation about cement companies pricing. That stock is okay. And Max India down about 3.5%, 73.5 and counting. The deal has been done at such valuations that it maybe deserve the kind of fall that it got yesterday. The question mark is, can it recover soundly or will it continue to remain under pressure? I think that's the conversation. A lot of these stocks are under pressure, and let's try and figure out if they continue to remain under pressure. Parthiv, if you track any of these 2 or 3 names which were the key losers yesterday, Max India on account of the deal that they've announced and the valuations that it has been done at, or Rain Industries after the abysmal numbers that it posted in the quarter gone by?
A short comment on both, Neeraj. I think in Max India's case, I think the reason why the street has not cheered the deal is because I think the uncertainty that brings along when a balance sheet gets an influx of cash and a good long-term scalable business is sold off. So I think that's the key reason. And such stocks, I think, are never under radar. I think they're out of the checklist in terms of uncertainty that it brings along in terms of new capital allocation with this money. A special dividend does not help the cause, and you know how hardly the market discounts a lot of cash on the balance sheet. So that's the case in point in Max India. Rain Industry, absolutely. I think ever since the aluminum market started deteriorating, and this was, I think, one time a stock which was, I think, a multi-bagger for many, and I'm not sure how many have been able to exit. But this is a big problem with some of these select commodity names. When the earnings collapse, they collapse by a huge intensity. So I think still there's a lot of uncertainty surrounding the aluminum market where these guys are big suppliers to. And I think the volatility and even the Chinese data of late, the Chinese PMI data going below 50, I think should not bode well for such selected commodity plays.
Well, another 4% gone, and I think that chart tells you the story. Yes, mid caps and small caps have corrected by and large, but Rain Industries in particular, with the 75% cut, shows that deterioration in fundamentals that have happened for that counter as well. Down in the session, looks like start off lower in the session today as well. Jet Airways remains under pressure, 8% lower. The news flow, of course, is that more planes have been grounded, and now I think in total about 10 odd planes grounded thus far because of non-payment of dues to the lessors. 6-7% now, so those rates are changing, but keep this stock at the back of your mind. This could well turn out to be the stock of the morning. What else? The Z Group stocks were the other interesting set of names the last couple of days. I don't think they are reacting too much today, but they will be right up there when it comes to the movers and shakers. Is there a trade in the oil marketing companies though? That's the question that I think we need to ask our experts. Sameet, Chavan, OMCs, crude has moved up a bit. It's not showing in the stock prices right now. What do the charts indicate for BP, HP, IOC?
See, these stocks, have been consolidating of late, but within this space, if we have to pick any particular stock, then BPCL has been our preferred pick. It has been showing a good strength, and if you look at the overall, chartical structure, this stock has attempted once breaking its previous resistance of 345. However, this attempt got rolled into, but overall, if you see, the weekly chart looks quite encouraging. So we would rather wait for some kind of breakout to happen. So breakout beyond 345 would trigger a strong momentum in the upward direction. So BPCL seems to be a preferred bet. Wait for a breakout to happen beyond 345. It would unfold the rally probably towards 368, 370.
Okay, that's for the oil marketing companies in light of what the crude oil has been doing as well. And I was talking about Tata Motors earlier on, and 180 right now. Last 7 days, the stock's up 10%. You should pull up actually the stock right now about 1.5%. Shrikant, the stock in the last 10 days has not performed badly at all. At 180, is there more leg room to buy into the counter?
See, certainly one thing is very clear, that the stock is into medium-term breakout. It has broken its important resistance line or supply line on weekly basis at 175, 174 levels. And after that, we saw a good amount of momentum and volume expansion. So it is heading for the levels of at least 193 or 200 in next maybe few months. So it will take time, but certainly it's a buy on each decline. Currently, it is around 177. And it is diverging positively. So another thing that we always correlate with price pattern is oscillators. And if oscillators are like supporting, then we should look for adding long position, even if there is like a good amount of let's say weakness or a previous sell-off of the past. So it is a buy, but buy with a medium-term view, buy at least with a view of next 2 to 3 months. Buy at current levels, buy more on dips, and keep final stop loss at 165. And we can expect minimum 200, 205 on the high side.
Parthiv, we had a conversation with Sameet Karla the other day, and he was of the opinion that Tata Motors, the worst for it is over. And even if you do see a downside, it's going to be a fairly limited downside from these levels. And, post that mammoth loss that they actually posted, they are taking measures to make sure that they come back on track. They are taking cost control measures in order to spruce up their books as well. Do you think that it is probably somewhat of a bottom for Tata Motors now, and things will start looking more positive?
Yes, Devin, I do concur to the view that, the worst is probably seen in terms of the price. But whether I think the stock will again go back and check out its glory days soon enough is a doubt that I still have. Most importantly, I think the rally that historically in the past that we've seen in Tata Motors was on the bank of JLR's volume growth in China. And China being such an important market for them has been totally collapsed. And there's been competitive pressures, there have been margin pressures, and even the JV out there has not worked out in their favor. But I think the saving grace for Tata Motors over the longer horizon, and especially the JLR, would be its new pipeline. And generally we have seen whenever they've replenished their pipeline, I think we've seen some sort of steadiness in terms of the volume growth coming back, the margins again inching up. So that is what we are expecting to happen over the next course of 2 to 3 years. Domestically, I think the operations have kind of stabled up, but still I think one can't say that it's still firing on all cylinders. But nonetheless, at the range of 150, 170, that's where probably the market seems to be in the mood to kind of have a bottom in place for this company. But yet, I think one should monitor the developments in terms of what sort of cost-cutting measures that they've already taken and how that will impact the return ratios for JLR. And yet, they have to invest a lot in technology and R&D development. But another saving grace for a company like JLR is it is surrounded by technology heavyweights like TCS, Tata Elxsi, which are the group companies, and which is always beneficial in terms of the synergies that they can bring, because automotive is moving more towards the technological way of driving the cars. So that's where they could have advantage, but it'll be a longish kind of a journey. But yes, I do agree that this is nearing the bottom for Tata Motors.
Minutes away from markets open. Sorry, Parthiv, were you wanted to finish your point?
was able to finish my.
Okay, you were able to. Okay, great. Let's just, minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. First up, debt-laden Jet Airways troubles mount as lessors ground another 7 planes due to non-payment. At least 10 planes have been grounded this month. The stock likely to start off 3% lower.
Wipro will sell Workday and Cornerstone on-demand businesses to Allied Solutions for $110 million.
Odisha Cement, soon to be renamed Dalmia Bharat, has filed a complaint with authorities that mutual fund units worth 344 crore rupees were illegally and unauthorizedly transferred from the demat accounts of Odisha Cement and Dalmia Cement East.
Tata Metallics said it will increase ductile iron pipe capacity by 2 lakh per ton per annum and hot metal capacity by 0.7 lakh ton per annum. The capacity expansion will take place by FY22 with an investment of 555 crores.
And in key brokerage calls, CLSA maintains sell on Vodafone Idea with a price target of 27, says leverage likely to remain out of control for the management. 20.5 is where that one is trading right now. Let's see if there is some more downside here or no. Parthiv, just wondering, would you switch? Would you get out? Would you play within that space? If you had investments in Bharti and Vodafone, would you switch them into Jio or rather Reliance, or would you get out of the space completely and use the money somewhere else?
See, I think purely on telecom front, I would still hold on to my positions on Bharti Airtel. Yes, I have apprehensions on Vodafone Idea. I think how the future pan out and a lot of equity dilution going ahead for them and the uncertainties. And I think Bharti Airtel is there to stay and it will be a strong player. In case of Reliance Jio, I think it's a very difficult call because to buy Reliance Jio, you have to buy the other businesses. And we are very bullish on Reliance Industries on the whole, no two ways about it. But I think it will not be a very fair comparison to compare Reliance Industries vis-a-vis Bharti Airtel. And one can have both the companies in the portfolio because, you know, you are diversifying in terms of the sector as well by playing with Reliance Industries. But talking specifically about Bharti Airtel, I think, again, this is a company where over the next 6 to 8 months, we might see the worst being over. And even at 103 ARPU, they are able to garner an EBITDA margin of somewhere around 34%. So even if there is some sort of revival in terms of the ARPUs, I think this is a company which is very well positioned to have that operating leverage. So I think they've maintained their market share, they've been innovative, and I would say in terms of performance, they've been far better than Idea Vodafone even as a combined entity. So we are bullish on Bharti Airtel over the next 2 to 3 years horizon.
Okay, minute and a half left to go for market closing. Just want to quickly get in those top calls from our technical experts. Sameet, what's going to be your top call for the day?
See, I'll stay with McDowell, which has been showing some kind of strength, and you know, yesterday also we saw the stock bucking the trend. So I would go with McDowell, target 568, stop loss 521.
Shrikant, what about your top call?
See, markets are opening higher, so Vedanta is also going to open higher. So I think there, like, we should look for taking contra bet of going short with a stop loss at 168, and we can expect 160, 161 on the downside. So short Vedanta at current price.
Sameet, Motherson Sumi for one, the day before had a really swell run. The stock was up, I think, about 10-odd%. Today's session, though, in the green, but not that, you know, a big momentous gain. But what would you do with the counter right now? A quick call.
See, if we look at the monthly chart, it appears that stock has formed a strong base around its major support levels of 130. We have already seen a good recovery. We might see some kind of consolidation, but any dip towards 150 would be a good buying opportunity. And the next leg of the rally would unfold once the stock surpasses 162, 165.
Okay, let's wait and watch if that happens and when that happens. Gentlemen, just stay on. We'll take in opening thoughts from you, but it promises to be a start in the green. The question mark is, can we hold on to that? It's been resilient the last 2 days. Let's see if we build on from where we start off. About 44 points on Nifty in the green, I might add. Sensex 150, the Nifty Bank about 100-odd points, so it's not a bad start for the large caps. Let's see what the mid-cap indices are showing on open. The mid-cap index has been very resilient the last 2 days and starting off about 0.5% as well. So not a bad start. The small-cap index about 0.25%. So the morning is not looking bad. The question mark is, can we build on from where we are right now? Let's look at the heat map. lot of green, very little red. And a lot of small gains to a bunch of stocks. So Yes Bank, Tata Motors, Adani Ports, actually some of the beaten down names. So I won't call Tata Motors a beaten down name because it's at 185 from 150. So it's shown a bit of an uptick in the last few days. Coal India, Reliance Industries too in the green. No noticeable moves on the gaining side, but for Yes Bank, which is up 1.5%. But aside of that, a clutch of names moving up. This could well change because look at this row. The gains are really, really tiny. What's not doing well? ONGC about a couple of percentage points, 2.5% lower. OMCs are not quite reacting to the uptick in crude prices, and IT seems to be marginally off. But aside of that, no big losses. Just that the index has quickly pulled back from those opening tick, so about 31 odd points. But early days, just the first 1.5 minutes, these rates will change in a bit. Very quickly, a couple of trending spaces that I want to highlight before I hand it over to Devina. Firstly, stocks. First, Jet Airways, clearly the stock of the morning, more planes grounded, and it starts off about 5% lower, very liquid name, and corrects quite strongly on open, does Jet Airways. So that is the first stock to monitor. Couple of other newsmakers and market movers. Firstly, the cement names. Is pricing power indeed back? That's the question that most investors would be asking. But after a good day yesterday, they're starting off in the green, which is actually a really good sign. All three mid-cap names starting off very well. And then let's see if the PSU banks are doing an encore too after having a very good day. Well, some of them are. Lakshmi Vilas Bank certainly is. Allahabad Bank and Corporation Bank. Just a flattish start to the trading day. Devina, what are you spotting?
Well, forward from yesterday's gains, Take Solutions at 132, which is up 4% today. The last 7 days has been up 60, almost closer to 31%. Suzlon is up again 5% today, takes its tally of 7 days up to 62%. Linde India is the other one that was doing okay for itself, 4% today, follow through from yesterday, 11% in the last 7 days. So these are all gains, big gains coming there. GVK Power and Infra yesterday saw marginal profit taking. Today's session back in the green, 7.5 rupees on the stock, smaller name, but doing really well in the recent past. Future Retail 2.5% higher, Praj Industries 2.5%. Motherson Sumi, we were just talking about that counter, that's up about 2% too. Berhampur Chini should pull up the other sugar names as well, Praj being one. You have Berhampur Chini, Bajaj Hindustan, Sri Lanka Sugars, Dhampur, Mavana, all these names. Last month has been a good one for them. Structural move on the stocks and holding on to those gains. Canfin Homes up 1.5%. You've got Reeves Cotton that's moving up to about 2.5% on the counter. Oriental Bank that's up 0.5%. Dena Bank is up about 1%. TVS Motors and Marico from the FMCG pocket is doing okay. Breadth of the market extremely positive. I think 1:4 in favor of the advances. 853 stocks advance, 240 stocks in the red. Amongst the losers, you all highlighted Jet, which is down about 5%. RCOM is down 1.5%. Rain Industries, yesterday's big 10% drop, carries forward to today's session of a drop of 2% that the stock is seeing. Varun Beverages 1.5% down. You've got the likes of Hindustan Zinc, GMTC, Info Edge, which was up yesterday, trading very close to its 52-week high. Remember, Info Edge's 52-week high is somewhere at 1,819. It closed around 1,809, but today's session is down in trade by about 1% or so. So overall, not a bad start at all. In fact, just gaining more weight as we speak. Getting some opening thoughts from our technical experts. And I want to come to you, Sameet, on Info Edge. Very close to its 52-week high, but not yet managing to scale it.
See, clearly this stock has shown a good amount of strength in last 2 to 3 months. It's been making series of high top, high bottom formation. Yesterday we saw good bump up, and in this process the stock managed to surpass its previous high. So looks good. Probably today's dip is likely to get bought into. 1750 would act as a very strong support. So any dip toward those important level would make it a good risk to reward ratio. So one should trade with a positive bias, and looking at the overall structure, price and volume activity, we won't be surprised to see this stock heading towards 1900 over the next few days.
Shrikant, just a quick thought on the index at 10,843. Are you taking some positions?
See, one thing is very clear that the market is under a lot of pressure, especially because it's a day of expiry. We are of the view that we should look for taking some short bet on the Nifty with the final stop loss at 10,900. So till the market is not crossing 10,900, we are expecting market to remain in a range. And again on the downside, 10,750, 770 is not ruled out. Again, if you go through with other index heavyweights like Lever, HDFC, Reliance, all are under a lot of pressure. So we are of the view that market should come down from current levels.
Okay. Shrikant, Sameet, thanks so much, gentlemen, for joining in and giving us that perspective. Parthiv, just very quickly, lots of queries about some of the banking names. Do you by any chance have a view on IDFC First Bank?
Yes, I think, Neeraj, this is a very good investment bet, but for a very long horizon. We have a lot of faith in terms of ability of Mr. Vaidyanathan, in terms of how well he can mitigate the problems and the issues that one talks about, which is the liability franchisee. He has delivered it in the past with turning around Future Capital Holding, which is now Capital First, and how from a 100 crore book, he is at a 30,000 crore book, and with very, very well efficient operations. So I think what we feel is that one price to book, I think it's not at all expensive, and one will have to be a patient investor in this to reap very, very rich rewards. But give it 5 years, and I think this will be a multi-bagger bank that one should own in a portfolio.
Okay. All right, Parthiv, we leave it at that. Thank you so very much for joining in. Appreciate you taking out the time, and it was good having our technical experts also with us this morning. Getting in an important voice, Andrew Holland, CEO of Avendus Capital Alternate Strategies. He's joining us on the show right now. Andrew, good morning to you. Lots been happening. Markets fairly resilient in an extremely volatile environment. Is it time to look at this as an opportunity rather than to sit on cash?
I think it's an opportunity for sure in certain stocks, which will get tarred with the same brush. But I'm not thinking that it's an opportunity to buy the whole market, because there's still, let's just take away the geopolitical issues for a second. You just seen some China PMI data come out, which is very poor. The US, to my mind, is in recession. So you have a lot of global headwinds in terms of global growth, which I think is slowing very dramatically now, which will affect our market. So I think you're going to get over the next 3 months up until the elections and maybe around the elections, plenty of opportunities to buy this market, but in particular individual stocks, because whilst the index is kind of holding up here, the damage underneath the index in the broader market is still very significant.
Mm-hmm. The other important part now being, while we're also observing the macros and not just the earnings and the micro aspect of it. So today you're going to be seeing the GDP numbers, the quarterly GDP numbers ended December coming out. 6.8% is what we're expecting. But how do you blend both these factors together to take a constructive call on the market?
So let me just kind of sidestep your GDP question for a second. This is how I think things will play out, and this is what we're thinking overall, is that if we're correct that the developed markets are in or heading towards recession, then one thing is for sure, a few things will happen there. One, interest rates will come tumbling down globally, and they will here as well. But the bigger factor is that obviously commodity prices will fall, including oil. So once the kind of dust settles on the slowing growth, and if we have a more stable or stable-ish government where we can see that reform process will continue, then I think India will be off to the races in terms of investments from foreigners, and also will still be one of the fastest growing economies in the world. So I think all of that plays out well. It's just the next 2-3 months is going to remain horribly volatile, which it has been for the last 6 months anyway. So you just have to use these opportunities to pick individual stocks before thinking about the whole market rising, which I think will happen after the elections if any of what I've just said plays out.
Andrew, so let's work with an assumption that it's right now slightly difficult to call the market because of the pushes and pulls. I mean, if indeed the US-China trade decision comes out to be positive, and Robert Lighthizer comments yesterday seem to suggest that the tariff increase might not happen until the talks are on. So there are pushes and pulls, and we can't quite figure out what the benchmark index could do. Would you presume that this is a good time to go out and shop into some of the pockets that have been beaten down due to presumably temporary periods of stress? Autos a case in point.
No, I don't think so. I don't think I'd want to buy into any kind of sectors which, I think will continue to underperform. So, the auto sector would be one of them. Yes, you will get those kind of moments of positivity for the sector, but I think it's a structural sell. I think it's all over in terms of the great growth that you've seen in the past 3 to 4 years. If anything, now we're just going to see time after time analysts having to reduce the forecasts. In terms of the NBFC sector, which is obviously the other area under stress, this second wave which is happening, I think is probably worse than the first time around in September, October, because I think it's starting to impact the real estate companies, and that's a huge, going to be a huge problem for these NBFC companies, and obviously for the banking system. So I'm just a little bit wary in dipping my toes in beaten down sectors, because I think they'll remain beaten down, if not probably be under further pressure. So I'd rather stick to quality at the moment, I'd hide at the moment in terms of FMCG, IT, and certain selective stocks, but not really kind of chase this market because of the volatility I talked about, and wait for the opportunities in single stocks.
Just wondering, this pessimism in autos, is it correlated to the stress within the NBFC space, or would you reckon that there are other issues at hand? Because frankly, if you look at just the demand pull, aside of this NBFC glitch that has happened, you don't see too many factors which could be impacting the natural course of demand for the auto names, right?
No, I mean, you're going to get demand for autos, but it's not going to be at the pace it was over the last 4 to 5 years. So that means is that you get maybe single-digit growth. But what that means is basically two things. One is that your margins get squeezed because your operational gearing actually kind of starts to come off. But what you'll see is, company after company either, discounting prices or, spending more on advertising. So, you're going to have all of that, which will affect your margins. So therefore, forecasts have yet to be brought down to the levels at which I think need to be. I think there's another 10 to 15% downgrades to come in this sector. So I don't need to buy it yet. I can wait for those downgrades to happen before looking to buy it. So I'm not saying the overall demand for consumption for cars it's not going to stop. I'm not saying that, but I think the heady days of strong growth, profit growth is over. And the valuations have to reflect that, which they're not, because no one's taken the knife to their profit forecast yet.
You are saying that there is more downside?
Yes, definitely. 10 to 15% downside.
Wow, okay. That's one headline from this interview, Andrew Holland. So thanks for that. The other bit is this very consensus belief about how corporate-facing banks, even PSUs, will have very heady profit growth because of the credit costs coming off. Difficult to time the quarter, but it will happen. Are you in sync? And if you are in sync, are some of these stocks, including the SBIs and the PNBs, if not the smaller ones, or SBI and BOBs, if not the smaller ones, are all of them a buy?
No, I don't think that the whole sector's a buy. I still like the private banks. So what I'm thinking here is it's very simple. We're coming towards the end of the non-performing loan problem for all of the banks, and that will start to reverse going into 2019. We've seen some of it a little bit already, and that's where you're going to get the big earnings kicker for the whole banking sector, and then that's the great news, right? But if we look at the fundamentals, then the private banks have the capital and the balance sheet to go ahead as India continues to grow. All the PSU banks just have the capital just to survive and not really kind of move ahead. So they're going to continue losing market share. So the best case you can say for PSU banks is that they all merge or do something. But I'm not even saying that 1 + 1 and +1 = 3. It probably doesn't. It's probably less than that. So, this is going to be a long kind of process for these banks to either merge into something bigger, and then you've got to see what the management's going to do with that and who the management is of some of these larger PSU banks. So I've always said, and I'll continue to say, that PSU banks will have their day in the sun. They always do, but you rent it, you don't own it. There's no need to own PSU banks.
All right. So, you've spoken about banks, you've spoken about autos. Where does the growth come in now from? What is the pocket that you're looking at? Are you going to look at infrastructure as a pocket now, the likes of the L&Ts of the world? Are we going to look more towards investment-driven sectors? Are we going to look at the more expensive consumption-driven sectors, which could likely become even more expensive? But people are ready to pay for it because the opportunity persists. So what is it that you are going to put your finger on and say that this is likely to be a good investment?
So we continue to like FMCG despite the ratings. We think it's both a short and a long-term story that's not going to go away from us. So I'm happy to pay these kind of multiples. If anything, if for any reason they come down, then I would continue to buy. So FMCG is a whether you have a bull market or a bear market, you just have to have them in your portfolio. The infrastructure story which you're talking about, I think, is a second half 2019-20 onward story. If you have a stable government, then what you'd see is obviously the government would continue to spend money on infrastructure. Given that a lot of industries now are running at capacity utilization of around 75-78%, they're going to have to start doing some capex. So I expect the private capex cycle to start picking up in the second half of the year. But that's all on the basis that you have a stable government, which will continue with the reform process that we've been seeing in the past 4 or 5 years. So it's a little bit early to do that, but I would look at infrastructure, capital goods, kind of second half of the year. If you're more adventurous, you could obviously take an earlier call, but I think I'd rather just wait. I don't mind missing the first 5-10% if it's a longer term upward trend for the sector and have that certainty first. The other sector which is something which looks a little bit more compelling than it has been is pharma. I still can't get myself over the line on the sector because of all the problems that they just kind of seem to keep having. So probably more domestic focused pharma stocks is probably where I'd look to increase weightage. I'm still not convinced I need to be in generic US pharma exposed companies at the moment.
All right. Just one last question. While Q3 this time around for Nifty 50 companies have shown stable growth, about revenue growth of 16%, profit growth of about an average of about 22 odd percent, the market has really not reflected that. If we get a stable government, earnings continue this trajectory. From a market standpoint, the growth in prices, will they match growth in earnings?
So don't forget that last year we had a year where we had actually the last 4 years or so we've had no earnings growth, but the market's moved higher, right? So there's always a bit of catch up to do in terms of earnings, being better and the market's doing nothing, and that's fine. I think our view is that 15% earnings growth for this year, if we're correct that the stable government plus private capex taking off in back end of 2019, then you're probably looking at 20% earnings growth. And I would have thought the market would move in line with that, in line with the earnings growth. So that would be our base case.
Okay, Andrew, we'll leave it at that. Pleasure talking to you today. Thank you so much for taking the time out and being with us.
Great, thank you.
Well, curiously, we didn't talk about the geopolitical tensions because the markets don't warrant that. Just the fact, Devina, that We've come off from the highs of the day, so that should be kept at the back of the mind. Nifty 50 is now flattened out completely. Banks about 0.25% higher. But, well, that's the nature of the day. The last few days have been extremely choppy and volatile. We take a quick break on that note. On the other side of the break, we discuss the business outlook for VIP industries with Chairman Dilip Piramal, and then speak to Federal Bank Shyam Srinivasan about asset quality, loan growth, and more.
Fulfill your dreams of buying a new house, new car, or achieving academic success. Attractive interest rates and easy processing. The trust, commitment, and excellence since 1937. Indian Overseas Bank, good people to grow with.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
They're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Back with Indian Open right here on Bloomberg Quint. Travel and wedding, two occasions that require us to pack our bags and hit the road, have once again led to strong sales for bags and suitcase makers in Q3. VIP still dominant, still growing despite the size. Volumes grew nearly 35% in Q3. Agam had a chance to chat up with Chairman Dilip Piramal and started off by asking him about the factors that are driving growth for the industry. Listen in.
Well, everything is going good for the industry and for VIP particularly. And this is not one of our strongest quarters season-wise. In fact, our strongest quarter is the first quarter, April to June. And then, if anything, it is October to December. So, so October to December was a good season, but then that's every year. So the growth is on the same quarter last year. So the main factors of the growth is that I'll first talk about the industry. The industry is growing extremely well. And I think with GST, we have got a further impetus. So our industry is basically is driven by the travel industry and the marriage season. And marriages, of course, that spending depends on the growth of the economy. So the Indian economy is growing extremely well. Travel industry is booming. In fact, tourism is one of the fastest, probably the fastest growing industry in the world. So, and not only Bombay and Delhi, but a lot of international airports also are working at full capacity. In fact, like they are chock-a-block, Bombay airport particularly. So, That shows that the travel industry is growing well, and if the airport capacity is available, they'll grow even more. So that is a very good sign for us. Then the general economy is doing well, and GST has given a good impetus to us, particularly in the smaller items, where we seem to have taken a good share from the unorganized sector. So all in all, there are a lot of tailwinds for the industry and for VIP, and we seem to be going fast ahead in that.
Okay, so Mr. Piramal, when it comes to the industry, and you in the past you've also spoken about the fact that there is plenty of space for all players in this particular industry to grow at this point in time. That said, your market share is also significantly higher than about 50-55%, if I'm not mistaken. And I'm not well versed with the latest figure, but the last number I've seen was at around 52%.
Yeah.
My question then is, where do we go from here when it comes to your market share, and what sort of churn are you seeing when it comes to the unorganized sector as against the organized sector then?
Well, I will now talk about, I spoke about the industry, I'll talk about VIP industries. We are in all segments of the luggage industry, right from the very top where we have the Carlton brand, and then our the largest segment is the mass premium segment, where we have VIP and Skybags, and both of them are doing extremely well. The rate of growth in Skybags is even more. And then in the economy sector, we have Aristocrat and Alpha. So we are growing extremely well in all the sectors. Then we have our handbags brand, Caprese, which also has become the largest brand in this sector, in the ladies' handbags. So we're seeing good growth in all the sectors. And we have got very good market share from the unorganized. I think that is for the entire industry, that in the lower end we have and the unorganized sector is in the lower end. So we have got good market share there, particularly in small items like backpacks. We have seen the maximum growth in backpacks, and this trend will continue. We are not too concerned about the churn from the unorganized sector. That is because we concentrate more on what action we have to take. And I don't think that we don't think of grabbing share from the unorganized sector. What happens is that the customers, the consumer, graduates from the unorganized sector to the organized sector, and new consumers come in. People who have not been using luggage items so far, they enter the market, and they enter through the unorganized sector. And that is the case with any industry where there is a large unorganized sector. So that is what happens with us. And we are happy as long as our rate of growth is good.
Okay, so let's talk about the emerging part of the market then. And at this point in time, from what I understand, that you do get a substantial amount of revenues from your brands such as Skybags and VIP. Majority, if I can call it that, about good 60-65%. And please correct me if I'm wrong on this particular number. How do you anticipate the change in trends as we move into the next 1 year or so? Or do you expect the large demand to remain the same, and in terms of trends?
Well, let me tell you that Skybags has grown the maximum in the last 5 years. But in the current year, it is Aristocrat which is growing the largest, because Aristocrat is our economy brand. And as I said, that we seem to have gained share from the unorganized sector. So that happens mainly in Aristocrat. And all our brands are growing well, VIP and Carlton. Of course, the base of Carlton is very small. So I don't think that there is going to be too much of a change in the trend. It doesn't really matter to us.
Okay.
As long as our overall sales are good.
All right.
We are quite happy.
Okay, so Mr. Piramal, it's curious that you spoke about the growth in Aristocrat, because what I was also reading was that because of the fact that Aristocrat has been growing, for you, well, because that it commands relatively lower margins is the reason why we have seen a little bit of a drop in the quarter gone by when it comes to margins. To what extent would you attribute to that when it comes to margins subduedness? And is there anything else when it comes to input costs as well, considering a lot of your inputs are linked with crude as an attribution to, well, your margins coming off?
Well, I don't think crude is a major factor at all, but the consequences of crude is that the rupee got depreciated, and we import about 50% of our overall products. So that has had a very strong impact on our margins because the rupee depreciated by about 10 to 12% in the last quarter as against the same quarter previous year. So that has had the biggest impact. Then the import duty was raised by 5%. So that is all across the board and for every company. So that was the biggest major increase in the cost. And of course, the margins in Aristocrat are a bit lower, and there is more competition in that segment because everybody is going for that segment now. And in the other segments, we are relatively comfortable. So all this has combined to have low margins, and because of the competition, we have not been very aggressive and in increasing our sale prices, which will now happen, I think.
Okay, so just two more questions then. Also a word on your international business. How's business coming along and the kind of contribution it is making to your overall revenues?
At the moment, our international business is less than 10% of our overall revenue. But in the domestic market, all the segments, there are about 8 trade channels, and I'm happy to say that all the 8 channels are doing extremely well.
Okay. If I'm not mistaken, that your e-commerce channel has certainly picked up, but that's again is relatively small in terms of contribution. Can you tell us a little more about that as well?
Well, the highest growth is in the e-commerce segment, but yet it is at the moment it is less than 10%. So the impact is not so much. But when the growth is very high, then gradually it becomes a larger part of the business.
Okay,
so it's a very satisfactory trend we are seeing.
All right, so then finally, just leave us with a little bit more on the outlook going forward with respect to your top line, perhaps your bottom line. I'm not asking you for an exact guidance, but any sort of indication would do as we move into the next financial year.
Well, the top line, of course, is growing at a very high rate of growth. And the margins also, we have had a setback in the margins in the third quarter, and that will continue in this quarter. But definitely they'll improve from the first quarter of next year. So on the whole, the outlook is, I'm very optimistic.
Okay, that's of course Dilip Piramal of VIP, and that stock did reasonably well in quarter 3, as did Federal Bank, which did reasonably well in quarter 3 too. We didn't speak to them then, but remember, it's sitting on a sizable chunk of non-performing corporate loan book at the end of the third quarter. What impacted the lenders' numbers slightly on the other side were Kerala floods in one way, but the bank management's rough thought seems to be, and confidence about that the worst is behind them. And what's giving them this confidence? Is it the healthy growth and fees, or is it something else? And how is the sector looking like? Let's get all of those questions answered from the bank's MD and CEO, Srinivasan. He joins us right now on the show. Mr. Srinivasan, good having you. Thanks so much for joining in. We're 2 months done into quarter 4 as well. If we look at the trajectory of the second half for Federal Bank and for the banking system in large, are you a lot more confident than what you were when the IL&FS crisis broke out?
Neeraj, thank you. I heard you say the introduction that we had a large corporate loan. I don't know which one. We really didn't have anything. For long, we've not had any of those issues. But that said, our momentum for the financial year and for Q3 and for Q4 continues to be quite similar to how we've seen the last, say, 12 odd quarters of credit growth. The shape of the growth we are trying to alter from being, as you would have noticed, we had very good growth for many quarters on corporate, and retail and other businesses were catching up. Now retail is taking over higher than even corporate growth by design. So the mix and the shift is more visible. We will try to get to 50-50 wholesale retail over a period of 2 years. Right now it's 57-43. And growth rates for all these businesses are north of 20. Corporate was growing at mid-30s, early 30s. I think we will bring it down to mid-20s. So the shift will be more visible.
Okay. Just wondering, So, okay, my reference would have been to select issues that would have cropped up, for example, slippages, which arguably were high, down 10% on a quarter-on-quarter basis, but full year slippages, I reckon, would still, Mr. Srinivasan, exceed what the earlier guidance or the earlier thought process was. Is that a reasonable estimate, or are you believing, as 2 months have gone by in quarter 4, that the numbers could change and change for the better?
We had said that the floods impact could be about 150 to 200 crores. That may be the only sort of material difference to our earlier observations. Otherwise, we are on trend and improving.
Okay.
So the earlier beginning of the year and the intra-year, August middle was when the floods. So we held out our first sort of feedback 20th August, almost immediately after the event, and our assessment then and now is pretty much along the same lines. We think the consequence of that would be about 150 to 200 crores, and that's how it's been the last two. A little better this quarter, but it's in that zone.
Interesting. So, Mr. Srinivasan, would it be fair to assume that some of the headline stuff for Federal Bank in terms of what could be potential issues are behind you? As I read, and as you've stated in the past, that the IL&FS exposure is all standard. I presume that all Kerala-related downgrades are done. You've probably stated in your con call that you do not see any kind of issues on the NBFC real estate portfolios as well. So the large headline issues that could come about are all behind you. Is that a reasonable estimate?
Yeah, I mean, whatever we said holds true. So all the three things that you pointed out are true. IL&FS, I mentioned about 240 crores is the total exposure to the SPVs, which are performing completed projects, either toll or annuity coming in. And they are, the biggest one is in Amber, about 195 odd crores out of the 200 crores is an Amber account. And the recent NCLT announcement makes it even more clearer. But that said, the money is in the account, and we've got payments up until the last month. So yeah, IL&FS, that's the update. NBFCs, we've never had any major exposure of any concern, and where we started seeing some stress, we actually unwound some of it in Q3, and that will continue as the repayment schedules kicks in. On Kerala, I've already mentioned, right? I mean, the flood-related impact has been well addressed.
Okay. So I mentioned three things, which were the headline stuff. You mentioned that all of those three are as per what you predicted. Is there something that I've missed? Is there something that you would watch out for as a bank management? We'll come about the growth numbers as well, Mr. Srinivasan, in a bit. I'm just trying to get the sense around asset quality and slippages right now.
Nothing uniquely different for Federal. We are sort of in the market. We keep watching every development that is happening. At this point in time, I can only say the guidance that we offered at the beginning holds, except for this 200 odd crores of Kerala related. We haven't seen any adverse outcomes. If anything, it's an improving trend. And we've addressed some of our erstwhile NPA or erstwhile sold to an ARC even more materially. And at the appropriate time, we'll share the final outcomes. We are in deep discussions. So it's only a better outcome from where we are.
Okay. Now, the other bit is, once issues are settled with the growth numbers, and they looked reasonably okay. Loan growth was healthy, CASA was stable. I believe there was steady improvement in fees seen. Has the better part of quarter 4 shaped up as well or better than quarter 3?
The improvements that you've seen are not one-off in nature. They have not been benefited by any sort of non-regular transaction. So I think that's the run rate, and we believe that we are on course. And invariably, March ends up being the most crucial month in the 12 months, and in specific in Q4. And we are all sort of in line for delivering those good outcomes in March. I mean, I'd be wrong to sort of incrementally share anything differently, but yeah, we are on trend. Our momentum is on guidance, and we haven't slacked off on anything, and unlikely we will.
Right. Mr. Srinivasan, good morning to you. Devina here, and I want to shift focus from Federal Bank's financials right now, which we've already discussed at length. and focus a little bit more on the NBFC space. So your NBFC, the subsidiary that you have, that's Fed Bank Financial Services. I mean, chatter in the market up until now has been that, you know, the vacuum that NBFCs have left, banks are slowly starting to fill in. Is that something that's happening at your end?
Our NBFC, as you know, has had an investment partner. True North has come in as a JV partner about 6 months ago. We've brought in a very senior leader as the MD of the NBFC. We've got a very good bunch of new guys who've joining. And they are really on, for want of a better word, on steroids and doing a great job. And in some sense, the parentage helps them to be very competitive in the market. And they are very retail and granular focused business. So our momentum there is good. So between the bank's retail foray and the NBFC in its new avatar going into the market, into deeper geographies and select businesses, I think the formula looks good. They are not at this juncture in any form impacted by the overall sort of talk on NBFC because they are way below the threshold of any kind of big ticket lending or big ticket exposure. So I think at this juncture it looks quite good, and I believe they are organized for good growth.
So when you say the big ticket exposure is slightly more muted, does that change, or is that a stance that you have taken keeping in mind the market environment right now? Because for some of the other NBFCs as well, disbursements have come up because they're cautiously taking that stand.
Fedfina, which is our NBFC, like I said, is a very heavily retail-led NBFC, and they are continuing to grow on that count, and I don't see them slacking off. The book is barely 2,000 crores, right? So the ambition there is to grow it manifold over a 5-year period. And that's how the design of the organization is, and I think they are putting in everything, the architecture, to make sure that that growth of 30-odd% every year is possible, actually more, and that will happen because the structure, the focus is very retail.
Okay, Mr. Srinivasan, one final question really from our end, and I would want you to wear your industry hat and tell me the common conversation that comes up off late with almost everybody who analyzes banks is that corporate-facing banks in general over the course of the next 12 to 18 odd months will see a significant upping in their accounts simply because the credit costs will come off materially and will start showing in the books. Difficult to time from which quarter, but it will happen. How is the street right in being so bullish, and is there a sense that you can give us about how large could this gain be from when it could happen for the space at large, maybe for Federal Bank too, but for the space at large?
Yeah, I think that's the point you're sort of mentioning is if the fact that banks had choked off incremental corporate growth because the credit costs were higher, that is true. Now credit costs will trend down, and as resolutions come in, maybe longer, but it will come in over the next 12-18 months. These will only add up to the net outcomes, and to that extent the numbers will get a little more flattered, having had some problems in the last 2 years. And if and post-elections, if there is active pickup in the economy, I would believe that there would be very significant P&L gains near term. But if you peel off everything and look at it on a more steady state and sort of normalize for credit events in the past or the likely bonanza in the near future, good, well-run corporate-facing banks will see growth. And I do think for us too that is very true. We've put in a remarkably good architecture for corporate. As you've seen over the last 3 years, the growth has been very handsome. And we're mirroring that in our commercial banking space. And I think that will continue. And we have less of the big ticket problems. So I think the space is open for us and to some extent all the big names that are sort of on a resurgent mode. So I'm very optimistic and bullish on how the next, like you said, you can't time the quarter, but before long that will be a reality.
Before long indeed. Great chatting with you today, Mr. Srinivasan. Thank you so much for taking the time out and being with us.
Thank you.
Well, that's the view from Shyam Srinivasan of Federal Bank, a lot more bullish on the prospects in the near to the medium term. Well, with that, it's a wrap on this leg of Indian Open. On a note that the markets are flattish in trade, from Devina and me and the team that put this show together. Thank you so much for watching.
Fulfill your dreams of